Hello, good afternoon. It's a great honor to join you. I wish I could have been there in person, and it's great to share the session with Julia. I'm going to have a slightly different orientation in my presentation. I'm going to be focusing on the shifts in the financial sector, and in particular the FX market. Next slide, please. If we look at this in the broader historical context, before the GFC, we had lending to the private sector growth much faster than lending to the government. But after the GFC, and you see it in the next slide, the lending to the private sector was subdued, but lending to the government was increasing at a much faster rate. And in the next slide, you see that the impact of COVID was to accentuate that process even more. So it's very much the lending to the government, in particular the size of the sovereign bond market, which is a very, very important theme. Next slide. Now, of course, the bond market is a global market. And here we have indicated the major regions in terms of this hexagon. And next slide shows the increase in the cross-border flows, the cross-border holdings of fixed income securities between 2015 and 2023. The blue gray ribbons indicate the decreases. And you see that the biggest changes have been between the US and Europe. In particular, the European holdings of US fixed income securities has been the really big theme in this period. Next slide. And the one after that. Next slide. Now, the reason for focusing on the change between 2015 and 2023 is to get at the total. Now, most of that increase has been in the form of the holdings of the private sector. If we look at the official holdings, and here I'm focusing here on the foreign holdings of US Treasuries. The official holdings peaked at around 2012 and has since been pretty flat. Whereas if you look at the next slide, in blue, you see the private sector holdings, and the increase since around 2012 has been very much attributed to the private sector holdings. The blue line there indicates the proportion of the total holdings held by the private sector. So the story here is if you focus on the period 2015 to 2023, we are simultaneously looking at the total increase because the pink has been fairly stable, but also the primarily private sector-led increase in the holdings of fixed income securities. Now, because these cross-border holdings involve foreign investors, mainly investors, there is an important element of there is an important foreign exchange element to the holdings. Next slide. And the one after that. Let's go to the next slide. And therefore, there has to be a way that the investors can mitigate the risk from currency fluctuations. And the best known way of doing that is through the use of FX swaps. An FX swap is a transaction where at the beginning you exchange principal amounts at the current exchange rate. Next slide. With the promise to unwind that transaction at the conclusion, at the maturity of the swap, at the pre-agreed forward rate and at a pre-agreed date. So if you look at the next slide, we see the prevalence of these swaps in our BIS over-the-counter derivatives statistics. In particular, the outstanding amount of FX swaps has grown very rapidly over the last couple of decades. And next slide. The most important segment of this has been between dealer banks, from which we get the data, and the so-called other financial institutions. So these are the non-dealer bank financial institutions. They include long-term investors like insurance companies, pension funds, and other investment funds, but also the non-dealer banks as well, who will then be acting on behalf of their clients. In the case of FX swaps, using the other financial institutions, we've seen a threefold increase between 2009 and the latest number. So one number that you can keep in mind is roughly $60 trillion worth of outstanding amounts of FX swaps are due to the activities of other financial institutions. Next slide. Let's see how a euro area long-term investor, let's say a euro area pension fund, uses an FX swap to hedge the currency risk of a US dollar security. So let's start with this example. At the start, this euro area pension fund simply holds euros in cash, euro-denominated securities, and the liabilities are the obligations to its beneficiaries, mostly in euros. Next slide. What the euro area pension fund can do is then to engage in an FX swap. So it acquires the green segment, which is US dollar cash. So this is a deposit in a large dealer bank. And then it also acquires these off-balance sheet, these forward obligations and forward claims. So you owe dollars in the forward transaction, but then you also have a claim on euros as well. But with the dollar deposit, next slide, you can then buy the US dollar security. And so in this right, the diagram on the right, the pension fund is holding US dollar securities, but then the exchange rate is hedged because there is an equivalent forward obligation of dollars. So you have a claim in dollars as well as an obligation. And so the dollar exchange rate then can be hedged. Next slide. And the one after that. Now, I think one thing that we have noticed in the run-up to earlier this year was the hedge ratios of institutional investors had become fairly low. And what that means is only a part of the dollar exposures are hedged, but in particular, some institutions will have lowered the hedge ratios even further. And indeed, some institutions may not be hedging at all, and they'll be holding the dollar assets without a hedge. So this is a picture of a euro area pension fund that is holding a US dollar security, but without a hedge. But if turbulence breaks out, like it did in April, the pension fund can nevertheless mitigate any losses from dollar depreciation by engaging in a hedge after the event, ex post. So next slide shows you what happens when you then engage in an FX swap directly after the exchange rate starts to depreciate. What happens here is that you have now engaged in an FX swap, and so you see the dollar deposit in the middle, as well as the forward claims and obligations. But with those dollars, whereas before you would buy a US dollar security, now you would simply sell that dollars in the spot market. So next slide. And so the green dollar deposit in the middle has now become a euro deposit. So you have sold dollars in the spot market and you have bought euros. And so the right-hand diagram is exactly a similar one as to the previous one, except that the previous example, where you're hedging before buying the security, but you have now hedged ex post. Of course, what's happened here is that you have sold dollars into the spot market, and therefore you have put downward pressure on the value of the dollar. And as you do that, you can easily get into a feedback loop where the more you sell, the more the dollar depreciates, which then increases the incentive to hedge even more. Now, let me give you a little bit more evidence, and the next slide shows you that. From our triennial survey, we're currently digging into the data. So the triennial survey is the survey conducted by the BIS every 3 years. We survey around 1,100 dealer banks in 52 jurisdictions. So we have a pretty comprehensive view of over-the-counter derivatives activity around the world. And the headline number this time is actually quite notable. So for this year's survey, the daily turnover is $9.5 trillion. So that's a very, very large number. It's also a very large increase relative to the last time we did this in 2022. Now, it just so happens that the survey period this year was April, during the height of the turbulence. That was not by design. The sample period was, of course, determined well in advance, but it just so happened that the sample period coincided with a period of very intense market activity. And so the very large increase that we see a 28% increase in the total amounts. We believe is largely attributable, or to some extent attributable, to the turbulence in the market. The other piece of evidence that's also very interesting is that the activity in the spot market and in the outright forward market were the biggest increases. It's the FX swap segment, which is by far the largest, but we see the largest increases in the spot and in the forward. Now, this makes a lot of sense to us because when you're hedging ex post, another way to do it would be bank for a forward position with a short dollar leg, embedded. And that would mean that the dealer bank would then have to hedge. And the dealer bank would hedge by selling the equivalent amount of dollars in the spot market. And so whether you hedge through swaps or whether you hedge through a forward transaction, there would always be an equivalent spot transaction. So there's this potential for a feedback loop, which to some extent we believe was responsible for the events in April. And the other aspect to bear in mind here is the longer term and financial stability aspects. And let me finish with that. Next slide. This is the same chart for the total outstanding amount of FX swaps, but indicated by the maturity of the swap contract. And the large yellow segment here indicates the swap contracts that are less than 1 year in maturity. Of course, in practice, we know that the short-term segment consists of contracts that are of much shorter maturity than 1 year. So they're typically 1 month or 2 months. And there are even shorter maturities than that. What this segment also indicates is the maturity mismatch, potential maturity mismatch on the balance sheets of the long-term investor, because the way you hedge is you borrow dollars and you buy securities with those borrowed dollars. That's the way that the swap market works. But the borrowing is with a dealer bank, and the dealer bank will lend you dollars on a short-term basis. So you see that the yellow segment is by far the majority. That means that you're borrowing short-term but lending long-term. And even if the investor itself is a long-term investor, you are taking on a maturity mismatch. So there is a trade-off here between how much currency risk you bear and how much maturity mismatch risk that you bear. And the more you hedge, the more maturity mismatch risk you're bearing. And the risk here, of course, is that if you find yourself in a period of a dollar shortage, you will need to join in the scramble for dollars together with the other short-term users of dollars. And we saw that during the great financial crisis, and we also saw that during the March 2020 episode. And during the April episode, there were just the incipient signs of something happening, but of course that was prevented with the reversal of the tariff announcement on April 9th. But of course, this is something that we should bear in mind as we go forward. So let me go to the final slide. These are the links to the annual economic report chapter, where we lay out the details of the arguments much more fully, as well as a BI's bulletin that we published, and it was primarily authored in our our office in Hong Kong with authors there, and the ex-post hedging argument is developed more fully there. So let me conclude here and hand it over to Dan.
Thank you very much, Mr. Shin, for your stimulating presentation. Please stay online with us. Now, may I invite our moderator for the second panel session, Mr. Danny Rees, Head of Central Bank Cooperation, Monetary and Economic Department, Bank for International Settlements, to lead this Q&A session for us. Please welcome.
Well, thank you very much, Hyun, for that stimulating presentation. I'm lucky enough to work with Hyun, so I get to speak with him every single day. And every time I do, I always learn something. So that was really fantastic. Now, just while I'm waiting for some questions to come in from the floor, Hyun, I thought I might start off with one of my own, which is you highlighted how changes in global financial intermediation, and in particular, the rise of MBFIs, have made global and monetary and financial system more interconnected and potentially amplified the transmission of financial shocks across borders. But at the same time, this morning's session, which focused on developments in the real economy, we heard how there's greater fragmentation there. So I guess my question is, how might this fragmentation on the real side affect developments in financial interconnectedness? And can we sustainably have an environment where we have a very connected financial system, but an increasingly fragmented real economy?
That's a great question, Dan. And I think you've really got to the heart of the matter there. And I think the the event today really is a very good forum to put these two issues side by side. So clearly, on the fragmentation of the real economy, in particular, fragmentation of the greater regionalization. So that is really about the flow of real goods and, in particular, the operation of global value chains. But the financial aspect, of course, follows along currency lines. And so as long as the working capital and as long as the invoicing is done in US dollars, we will continue to see these financial flows, very much still interconnected. And given the outstanding amounts of US dollar denominated securities that will be held by global investors, these long-term flows are also going to be indicating this, highly connected set of holdings. Let me just mention one thing, Dan, that I didn't have time to go through. Now, in the hexagon chart that you saw with these very, very large flows, the important point there is not the net flows across regions, it's the gross flows. And gross flows means what is the size of the portfolio of holdings in one region vis-a-vis another region. Of course, there's also a compensating flow going the other way. So whereas, of course, there are very large holdings of non-US investors of US fixed income securities, there are also very large holdings of US investors in Euro area and in Asian fixed income securities as well. And what matters are really the size of those gross flows, not simply the net flows. And this is why, for example, the largest holdings are of European investors vis-a-vis the US. That's where we've seen the biggest increases. And this is so even though the current account balances are largest between Asia and and the US. And so when we think about financial flows, we really have to focus on the gross flows in order to see where the risks lie, to see where the hedging needs are, and so on.
No, thank you very much for that. And I think that really speaks to the relevance of the two sessions that we have today, because on the one hand we do have this fragmented real economy, but Hyun, as you mentioned, there's increasing interconnectedness on the financial side, which can go hand in hand with it. We have a question from the floor that I think follows very naturally from that one, so let me go straight there. The question is, do you see any sign of loss of confidence in the US dollar in the recent period? And I think here it's speaking specifically after the events of April. And if so, would that change the messages from your presentation?
Yes, so if you, and thank you for that question, which I think is a very, very important question. The second source that I highlighted at the end of my presentation, the bulletin on the ex-post hedging, addresses that question much more fully. So I recommend that that you could actually take a look at that. The short answer is, if we look at the short answer is no, in the sense that if we look at the portfolio flows of US securities in April, we don't see a very visible outflow from the US. So there was, in fact, a very small outflow of around $50 billion in April. But actually, that's really a drop in the ocean compared to the size of these flows. And what we saw in May was that there was a large reversal of that. So there was a huge inflow into US dollar securities in May, and that continued into June. So if the criterion for the loss of confidence is, was there a concerted portfolio outflow from the US, the answer is no. But having said that, of course, over the longer term, there could be a movement in the strategic asset allocation across regions. And there is certainly anecdotal evidence that many investment boards are having very deep discussions about these global allocations. But as far as the evidence is concerned, there is no evidence so far.
Thank you for that. And this will be an issue that we'll touch upon in more depth in the following panel. So it's a very nice introduction to that. Let me move in a slightly different direction now. So one of your first graphs, Hyun, showed the changes in borrowing by the private and the public sector. And one of the messages there was that a lot of the increase in borrowing, or an increasing share of the increase in borrowing since the GFC, has been through the public sector. And then you touched on, later in your presentation, ways in which stresses in government bond markets can be amplified and undermine financial stability well before conventional indicators of public debt sustainability can flag a problem. Now, I think most people in the audience know that various members of the international community have been taking steps to strengthen the resilience of these core financial markets that are affected by this. But maybe I could ask you, is this enough, and what other measures could or should be needed?
Thank you, Dan, for that. So that was the part that I had to go over very quickly because of lack of time. But let me elaborate on your very important points. So one of the slides that I skipped was a slide where I lay out why the conventional measures of fiscal sustainability may be a little bit misleading. So conventionally, we think about fiscal sustainability in terms of the interest rate on the debt versus the growth of the economy. So it's R minus G, so-called. So when R minus G is low or even negative, then the fiscal position is sustainable or it's very healthy. When R minus G is very large, this is when fiscal sustainability concerns, may start to emerge. And there's a net present value calculation which will decide whether you're sustainable, whether your fiscal situation is sustainable or not. The problem with that type of approach is that, of course, that gives you a sense of the long-term sustainability. But in the short term, financial stability considerations can kick in well before those long-term fiscal sustainability indicators, start to matter. So in particular, when you see a sharp increase in government bond yields, so for example, if you have a rapid steepening of the yield curve, then that can put in question the sustainability, not because of the long-term demographic or structural changes, but because the financial stability challenges will then put fiscal sustainability under severe question, in particular when there are very rapid portfolio outflows. And of course, one issue that is very much at the center of debate these days is the short-term funding market through repos and how repos are being used to finance very high leverage in government bond markets. And the very high leverage there is not an issue because of credit risk as such, because the government bonds are not subject to credit risk, at least not in the same way as for private sector claims. But it's more that when there's a deleveraging episode, you see very large changes in the prices, and in particular a spike higher in the government bond yield itself. So to answer your question, what can we do about these types of risks? Well, to some extent, it has to do with the conduct of the highly leveraged players. So how do we deal with leverage of the non-banks? And there, as Julia also mentioned in her presentation, there are regulations, there are different supervisory guidance that can be employed, and this is certainly very high on the FSB agenda at the moment. But in the end, there has to be, of course, the lender of last resort function of the central bank. In this case, this would be more of a liquidity provision function. And of course, that has many side effects, and it's something that the central bank will need to steer clear from during normal times. But we have seen in the past that the central bank may need to come in as a last resort.
Thank you. Now, I have a question from the floor that I think follows very naturally from this, and it moves to the other side of the picture. So we talked about the borrower side, the government bonds. This is moving to the lender side. And the question is that part of what we've seen in terms of the rise in government borrowing is a shift in intermediation from the banking sector towards the non-banking sector. And arguably one contributor to this has been post-GFC changes in regulation that have affected the kinds of assets that the banking sector can hold. And you talked at the end of your presentation about risks potentially flowing through the banking sector nonetheless. So the question is, were these changes in financial regulation a mistake? And would the financial system be less risky if banks instead of non-banks were more involved in these kinds of financial markets that you're discussing?
That's a very, very important question, Dan. And I think it's very important to point out that the banks are more important than ever and are more interconnected than ever. So let me explain what I mean by that. It's true that the frontline investors, so the investors who directly hold government bonds, tend to be long-term investors like insurance companies, pension funds, sovereign wealth funds, etc. But for the FX swap market, which is ultimately what is enabling all of the global portfolio flows, the FX swap market is primarily a banking sector market. And that is because the FX swap contracts are provided by dealer banks who can make money fungible across currencies. So, when an insurance company engages in an FX swap, it does that with a dealer bank. And these dealer banks are also precisely the same dealer banks that are active in the repo market. So these are the short-term lenders who allow leverage of the relative value hedge funds and so on. So in fact, what I would say is the more you worry about the non-banks, the more you have to worry about the banks, because ultimately it's the banks that enable the leverage of the non-banks. So in that respect, in fact, loosening regulation would not be the answer, because it would simply make the non-bank issue even more acute. I think the way to think about this is the more global the financial markets become, the more FX swaps and repos have to be at the center of the system. And for that reason, the banks are actually bearing even more risk than they were before. So we need to think about the financial system as a connected whole. And this is also why any problems in the bond market and in the repo market has the potential to spill over to the FX swap market, in which case this will be a problem that affects all investors everywhere, not simply in a particular jurisdiction.
Thank you very much. Now we have a couple more questions here that have come in, but in the interest of time, let me just combine them into one, which is a very broad question, Hyun, and goes probably a little bit beyond what you've been talking about today. But I think, given that I get to talk to you every day, but for this audience, this is for once in a not as often opportunity. What keeps you up at night regarding global financial stability?
So that's, of course, there are very few nights when, we can have, long, good night's sleep these days. No, I'm just joking. I guess the issue that I just described, I think would be the key one. So at the moment, the financial system is very much a system where we have shifted from lending to the private sector and the mortgage markets to one where the securities market, and in particular the government bond market, really sits at the center of the financial system. And although credit risk is less of an issue, liquidity risk and these big shifts in exchange rates and so on, the market risk really is at the center. And although we traditionally focus very much on the banks in terms of their credit risk, the other, this interconnected nature of the fixed income markets with the FX market and with the short-term money market, I think is going to be a really crucial theme, going forward. And although we didn't have a chance to talk about it in this session, but I see that you have other sessions today, the emergence of stable coins and the development of the monetary system is going to be a crucial theme. And I very much commend the organizers for putting that on the program as well, because the changing shape of the monetary system going forward is going to be a really crucial theme in the next couple of years.
Thank you very much, Hyun. Now, we still have 2 minutes left and one question has just come in, and I'd like to cover this because it is very important for the themes of the events today and for the mission of AMRO in general. So the question is, given that you don't see a loss of confidence in the US dollar, how important is it for ASEAN members to increase inter-regional use of local currencies for their economy and financial resilience? And where should this effort move in terms of other initiatives to boost financial stability in the region? And this one is by Jono Thompson from Central Banking.
Very good. So I think that's a very important and very practical question. And there are several aspects to this. The way that global value chains work is primarily through the US dollar, because this is the currency that all of the trading partners would find common acceptability in. So if you invoice in US dollars, the other components of the global value chain would also find that acceptable, and so there is a mutually reinforcing aspect there. So to some extent, the issue is about the invoicing currency. And of course, the invoicing currency goes together with the short-term funding market, because if you're going to invoice in a particular currency, you need the short-term funding market to provide you with a working capital while you're actually repaying those invoices. So the financial system is actually a very integral part of the trading system in that regard. And if you see the short-term funding market develop that way, then the financial institutions, for them, these dollar denominated claims will then form part of the financial system, which then builds another layer onto the pyramid. So to that extent, it's not an easy solution simply to change one aspect of this and have that change the status of the dollar. But it has to be a multi-pronged and multifaceted approach. So to some extent, it's about invoicing, but you need to develop the short-term funding markets together with that. And then there has to be the fungibility of those funds when you're interacting with firms outside the value chain. And so you need to have invoicing in a currency which would find widespread acceptability across the world. So it's also not simply the ASEAN countries actions is important, is also the actions of the currency that's being issued by the ultimate consumer country as well. So I'm afraid there's no simple answer there. It's something that's going to take some time. It's going to take a multi-pronged approach.
Okay, thank you very much, Hyun. Now my screen in front of me is flashing red, which I think means that we're out of time. Hyun, you mentioned not getting a good night's sleep. You had to wake up very, very early in the morning for this session. So please, if the audience could join me in thanking Hyun Song Shin. Thank you very much, Hyun.